Imagine a 16-year-old who turned $1,000 into $10,000 in a year, then lost it all because nobody told them about the hidden tax on their future returns. Hook_and, that might sound extreme, but it's exactly what happened to thousands of teens during the 2021 meme stock frenzy. They saw friends making quick money, jumped in without understanding the rules, and ended up with a tax bill bigger than their profits. Today, we're going to break down how investing really works for teenagers and why the advice you've heard about starting early might actually be setting you up to lose money.
Pattern_interrupt. Let's start with the setup.
Every YouTube finance guru tells you the same thing: start investing as early as possible, because compound interest is magic. Warren Buffett made 99% of his money after age 50, they say. But here's what they don't tell you: Buffett started investing at age 11 with a solid foundation in accounting and business analysis.
Most teenagers today start by buying options on Robinhood after watching a TikTok. That's not investing, that's gambling with a smartphone.
Pattern_interrupt, cliffhanger. The real problem isn't that teens invest too early, it's that they invest in the wrong things, for the wrong reasons, without understanding the mechanisms.
So let's go deep into Act 2, the mechanism. How does compound interest actually work? Imagine you invest $1,000 at age 15 and earn 7% annually. By age 65, that grows to about $30,000. Impressive, right? But here's the catch: you can't touch that money for 50 years. If you withdraw early, you pay penalties and taxes that wipe out most of the growth. Pattern_interrupt. Now, compare that to a 25-year-old who invests $1,000 but also adds $100 every month. At 7% returns, they'll have over $250,000 by age 65. The teenager who starts earlier but never adds more gets crushed by inflation and missed contributions. The real superpower isn't time, it's consistent saving combined with time. Pattern_interrupt. Here's where most teen investors get trapped. They see a stock like GameStop go up 1,000% in a month and think they can replicate that. But the data shows that 80% of day traders lose money. A study by the University of California found that the average retail investor underperforms the S&P 500 by 1.5% per year, and that's before taxes and fees. For teenagers, the numbers are even worse because they trade more frequently and chase hot stocks. Pattern_interrupt, cliffhanger. Let's talk about the hidden trap: taxes. If you're under 18, you can't open a standard brokerage account. You need a custodial account, which a parent controls. Any gains you realize, meaning, when you sell a stock for profit, are taxed as unearned income. For a teen with no job, the first $1,250 of unearned income is tax-free. But anything above that is taxed at the parent's marginal rate, which could be 22% or higher. So if you made $5,000 in profits, the IRS could take over $1,000. That's a 20% tax on your gains before you even spend a dime. Pattern_interrupt. Then there's the FOMO trap. A survey by CNBC found that 70% of teen investors said they bought a stock because they saw it on social media. The problem is that by the time a stock trends on TikTok, it's usually already peaked. You're buying into hype, not value. Think of it like this: if everyone is talking about a restaurant, you either have to wait in line for hours or the food is already cold. The same goes for stocks. Pattern_interrupt, cliffhanger. So what should a teenager actually do? Let's move to Act 3, the takeaway. First, if you have earned income from a job, freelancing, or a small business, open a Roth IRA. You can contribute up to your earned income, up to $7,000 per year. The money grows tax-free, and you can withdraw your contributions anytime without penalty. That's a massive advantage over a regular brokerage account. Pattern_interrupt. Second, don't try to pick individual stocks. Instead, invest in a low-cost index fund that tracks the entire market, like an S&P 500 index fund. Over the long term, the S&P 500 has returned about 10% annually. That's not flashy, but it's reliable. And it's the same strategy that Warren Buffett recommends for most people. Pattern_interrupt. Third, use the time you have to learn, not to gamble. Read books like The Little Book of Common Sense Investing by John Bogle or I Will Teach You to Be Rich by Ramit Sethi. Learn how businesses work,
how to read a balance sheet, and why diversification matters.
That knowledge will be worth more than any stock tip you find online.
Pattern_interrupt. Finally, focus on your biggest asset, your ability to earn money.
For a teenager, the best investment isn't in the stock market, it's in yourself.
Learn a high-income skill, start a side hustle, or get a part-time job. Every dollar you earn and invest now is worth more than a dollar you earn at age 30, because you have more time to compound. But only if you invest it wisely. Pattern_interrupt. Cliffhanger. Here's the forward-looking insight. In 10 years, the teenagers who built good habits, saving consistently, investing in index funds, and avoiding hype, will be far ahead of the ones who chased meme stocks.
The market rewards patience, not impulsiveness. And the sooner you realize that, the sooner you'll actually start building real wealth.
Pattern_interrupt. So if you're a teenager watching this, don't fall for the trap.
Don't think you need to beat the market.
Just start small, stay consistent, and let time do the heavy lifting. Your future self will thank you.
Pattern_interrupt. If you found this helpful, hit the like button and subscribe for more real talk about money.
And in the next video, I'll show you exactly how to open your first Roth IRA step by step.
See you then.